We all hate paying income tax, right? Well, what would you say if I told you I could boost my financial situation by volunteering to reduce my take-home salary? You'd think I was bangers, right? Well, grab a drink and let's mash into the details. Today, we're talking about adjusted net income. Before we get into the meaty details, let's make sure we're all speaking the same language. If I spend a day making this video and you understand none of it, that will just be the worst.
I'm sorry. I don't speak whatever it is you're speaking.
A quick recap on income tax brackets. You can think of these as your tax tiers all linked together. As your gross salary, that is, your income before tax and deductions goes up, you're going to find yourself being squeezed for more and more by the taxman. The amount of tax you pay is defined by the upper and lower limits of each tax band. So if you look at my representative model, you can see that as someone earns above 40,000, they move into the 40% tax bracket. But that 40% only applies to the income above £40,000. You can see in the model here, represented by red, that the amount earned below £40,000 is still only taxed at the 20% in this model. And anything below £12,500 is completely tax-free in this model. So hopefully that's 100% clear. Income tax doesn't apply at the same rate for all of your income. It applies to certain portions of your income at specific rates, and the previous rates apply to the previous portions of income.
I still don't get it.
I made a previous video all about Scotland and the rest of the UK's progressive income tax system. I'll link it down below in the description if you want to know more. The term qualifying earnings is used to refer to the amount of income you make between £6,240 and £50,270 only. If you're struggling with the math, the maximum value your qualifying earnings can be in this tax year is £44,030. Qualifying earnings is a really important term to understand, especially when you're trying to calculate your workplace pension contributions. That's because the value of your qualifying earnings is the legal minimum that your employer has to use to calculate both your, and more importantly, their contributions to your pension every month. To be 100% clear, even if you earn more than £50,270 gross salary in the year, let's say 60k, your employer only has to pay pension contributions on your qualifying earnings portion of that income. That is up to a maximum of £44,030 this year.
Not a penny more.
Let's let qualifying earnings cook for a little while, and I'll come back to that in more detail in a future video all about pensions. Adjusted net income, or ANI for short, is your gross salary minus certain allowable deductions, and that's the actual figure that HMRC use to calculate if you've paid enough tax in the financial year. So let's cut to the chase. What are some things you could do to make your gross income that little bit leaner?
Boy, I'm getting hungry.
Charitable donations, like gift aid, are a great way to link your generosity to tax savings. So for example, if you give £80 to a charity, they can claim back the basic tax rate on that, and that £80 is worth £100 to the charity. But here's the kicker. If you're in one of the higher income tax brackets, you could reclaim between 1 and 47.5% of your donation back as a deduction against your gross income, which turns out to be really helpful if you're one of the lucky few who's sizzling in the top income tax brackets.
Keep it, give it away.
To claim your tax deduction, you either need to complete an income tax self-assessment or just give HMRC a call and let them know about your donation and they'll update your tax code for you. Let's talk about salary sacrifice. This is where you volunteer to reduce a part of your gross income in exchange for certain perks. It's a win-win all round, a bit like ordering your hot dog and getting the ketchup for free. The most common salary sacrifice is pension contribution, and most of you will be auto-enrolled into this through your workplace. At the time of recording, the maximum you can pay into your pension, tax-free, is £60,000 or 100% of your earnings each tax year, whichever is lower. Meaning if you earn less than £60,000, let's say £40,000, the maximum that you could put into your pension in this tax year, tax-free, is £40,000 for you. You heard that right. Everything that you pay into your workplace salary sacrifice scheme benefits from what the government calls tax relief. Now, without going into the details of that, the net result for you is that everything that you pay into your pension is tax-free. So 100% of your contributions goes into your pension pot to be invested by your pension provider. Typically, this will be a default fund that your company has selected for you. If you're looking for a really good video on that subject, check out Damien Talks Money's video on pensions.
But wait, there's more.
If you're the kind of person who fancies sausage rolling your way into work every day, then you might look into whether or not your company offers a cycle to work scheme. Typically, these will allow you to buy a good bike at a discount price and pay for it monthly pre-tax through salary sacrifice. I'm not much of a cyclist though, and with the state of the roads around here, I'd end up like a toad in one of the potholes.
Did he really say that?
If your employer allows it, you could consider whether or not buying additional holidays through salary sacrifice is the right choice for you to reduce your taxes. So why would you do that? Well, if you think about it, somebody in Scotland on that dreaded 67.5% tax trap, they could purchase those additional holidays for effectively 33% of their day rate, because they're already losing that 67.5% anyway, but instead of that going to the government, it goes to nobody, or I guess your employer gets to keep it. They only really lose that 32.5% of their day rate in their income, and they got an extra day off work. Best of all, you get to brat to your colleagues about how you're getting extra days off work and paying less tax.
Money, 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 money.
If you've been following along so far, you understand the benefit reducing your ANI has on your income tax burden. But what are some of the other juicy benefits of doing this? Firstly, you can protect your personal allowance. If you earn over £100,000, you might want to trim some of that salary just to protect your personal allowance. By reducing your ANI, you can make sure that you keep your £12,570 completely tax-free and also avoid the 67.5% tax trap.
It's mine! All mine!
Secondly, pensions avoid inheritance tax. So anything you stack up in them during your lifetime is passed on to your beneficiaries 100% tax-free. Doesn't matter how long you've been queuing that money for or how old the person is at the time of your passing. They get that money 100% tax-free. It's a nice little tax loophole and I don't expect it to stick around forever, but it is something to consider because right now, those are the rules.
I don't make the rules.
Thirdly, if you or your partner's individual ANI is greater than £60,000, you'll start to see any child benefit fizzle away. 1% for every £200 you earn above £60,000. By the time you hit £80,000, you're completely fried. So by reducing both you and your partner's ANIs below £60,000, you can receive the full child benefit without being burnt.
Kids are expensive.
The last benefit we'll talk about is marriage allowance. If you're married or in a civil partnership, you may be able to transfer some of your tax-free personal allowance to your partner. It's like giving your partner a slice of your salami, but instead of a finocchiona, you're serving them up to £252 in tax savings. As long as one of you earns below the personal allowance, that's £12,570, and the other person's ANI is below £50,000, you can benefit from the marriage allowance.
My girl, half the money hurt.
So like all good things, there are trade-offs to doing this. Your adjusted net income can impact things such as maternity pay, bonuses, pay rises, mortgage applications, and state benefits. That is because on your pay slips, by reducing your ANI, you are taking less money home each month, and your employer, bank, and the government might consider that as your real income and use that when making decisions about your situation.
You got money?
No.
One thing to bear in mind, you cannot salary sacrifice your ANI below minimum wage. So if you're on a wee willy winky of a salary, these strategies may not be for you. That said, if you can afford it, adjusting your net income through salary sacrifice might be the most savvy sausage thing you can do to reduce your tax bill. Remember, always speak to a qualified financial advisor before making any big moves if you're not sure what you're doing. And nothing in this video is financial advice.
That's it! We're gonna go to jail! They're gonna arrest us!
If you got value from this video, please hit the like button, subscribe, and join the conversation down below. It really does help the channel. Together, we can turn personal finances from a frank struggle to a bratwurst dream.
The return of the sausages.